Okay, we are live with a Prospero market update. We have some good topics this week. We flipped the calendar from September to October. Hopefully, we get some better results this month, and it's actually even a new quarter too, so it's a double whammy. But let's start up with George, your market update and how you're feeling about the market in October.
Yes, and I'm going to quickly post that we are live on Twitter because I'm trying to be better about this. And then we'll take it away. All right. So I think where we are on the market, and let me get everybody live. QQQ and SPY option sentiment because it's been moving around a little today. Not like drastically, but up and down a little bit. Yeah. QQQ is looking pretty solid. QQQ net option sentiment at 41. And it is obviously doing better today than the SPY, the actual index. SPY is running a little lower. And obviously I called out, definitely a little lower. It's at 13. But obviously I called out a bit of a bull turn last week. And basically what we were looking for there was definitely a big increase in net option sentiment. Both SPY and QQQ net option sentiment were heading upwards. And they kind of did that pretty quickly. And we were, again, like 2 weeks in a row, we've been able to signal kind of the market turning in a bear direction before it happened, before the Powell speech. And then as well, like kind of in the bull direction last week, both in our trading letter, by the way. So yes, the main thing that we are talking about there is essentially the fact that we don't yet still have a lot of assurance in the market, and I think the direction of the market. And I think what we're seeing is even when we get some bullish news, there's kind of limited upside to it. And I think we're seeing that on an ongoing basis, and it's exemplified today. Like I put the portfolio a little more neutral, a little bullish, because I expected the announcement that there was not going to be the shutdown as something that the market would react positively to. And it was almost up. NASDAQ was up close to 1% in pre-market. But I only picked 5 bulls and 4 bears because I expected it to be the excitement to be short-lived in light of a lot of the factors that I'm talking about, that we have these kind of strong bear forces in terms of, broadly consumer credit. I would say inflation / interest rates, in terms of just like interest rates are now, continually staying higher longer. Powell made that announcement in terms of, the expectations changing on that. And, inflation is coming down, but people still want to see data on it. And last month's, I would say, was a little disappointing in terms of the momentum that we were building. So I would say those are the big factors pointing it down that there really aren't great answers to right now. And so I think that's going to limit my bullishness. But obviously 5 bulls and 4 bears this week in my portfolio is what I'm holding on the newsletter picks. And last week it was 1 bull and 4 bears. So there's definitely been a perception change and in terms of how people are playing both SPY options and QQQ options. And obviously that's what shows up in our net option sentiment. So yeah, I would say that, for the bulls, it was a good week, even though this week is maybe not as exciting as some might have hoped, given the numbers that were coming in last night. But still, I would say it's definitely more hopeful than it was looking last week when I kind of took my most bearish portfolio I've taken in many months.
Mm-hmm. Yeah, so one question I wanted to ask you directly related to this is that I know at the end of Friday was the end of Q3 and also the start of new calendar month. And since you've worked in institutionally on that side before, I wanted to ask you, like, do institutions make a plan for a quarter and then have a whole new plan book for the start of a new quarter? How important is the change in the turnover, or is it not as big of a deal as people think?
That's a great question, and it really depends on the fund. There's funds that are kind of like long only, no leverage, that they're really just trying to allocate, I would say, to the right sectors, to the companies among those sectors. And so, yeah, their allocations will shift, and there's a great degree of planning if, say, like, analyst estimates change or their own models change or things like that. But I would also say that varies all the way up to, long, short, heavy leverage, even special situation funds. Because what some people don't necessarily know about funds is stocks, especially if they're high leverage, high rate of return. Stocks are just one of the many games that they play. There's a popular category called alternatives, and one of actually my only sales job I've ever had was I was at a big mortgage and real estate fund, and I was selling packages of non-performing loans where the company I worked for actually would just buy a bunch from a bank that was not servicing them correctly. And then the rate of return on that was actually something like 25 to 30%, what's called an internal rate of return. And that's basically like the return that is being put against. And that was like a special situation alternative investment. And obviously the risk profile was that mortgages would get worse, but they had already gotten so bad that that was a risk people were willing to take at those 25 to 30% returns. And I give that story in a little more where it's just like those returns are always available for this kind of these hedge funds that are willing to take on like more risk. And so like that's what being competed against often versus just like I think people think of just like traditional bonds. But yes, I would say that those kinds of funds, they're not planning whatever comes through the door. They're expecting these exciting alternative investments to approach them all the time. So it's kind of just like how they want to balance their whole portfolio. And then their equity section is very much how a lot of these funds work is, and I've worked at more of a value fund, but not necessarily like long, short, but know many people at these kinds of funds where you're just pitching your best ideas all the time. Someone could walk into the chief investment officer's office or into the portfolios manager's office, depending on these different structures, pitch them an idea, and that could become 5% of the portfolio in a day if it's sold correctly and the idea is pitched well. So that's the whole spectrum. There's everything from, hey, we have our sector view. We're just going to shift stocks around based a little bit on how they're performing based on, the sectors that we like, or even broader. There's these things called like FAMA, I don't know why I put it in inputs. They're called FAMA French factors. And those are kind of like large macro factors that people kind of manage a portfolio allocation around based on how they're expected to perform in relation to those factors. So that's kind of like the most conservative. And earnings are going to like not affect that much, except they might tweak their sector allocations a little bit based on how companies report and how exciting the growth / profitability mix of those companies are. And it goes all the way up, I would say, to what I'm basically saying, where a huge allocation can kind of be taken out of some equities or some bonds to an exciting equity opportunity that gets pitched in any given day.
Very interesting stuff there. So yesterday I was just, sitting at home Sunday night watching football, and I get a text from my uncle who he was never involved in like finance, stock market or anything. And as I've gotten more interested in it, I've kind of got him into it. And whenever something big happens, we just send each other like the eyes emoji. So I get one of those from him like late Sunday night. So I'm like, oh, something's going on. I open Robinhood and all these other platforms, and I see that the pre-market is up, and I'm like, oh, so this is interesting. So what was the news? And then I remembered that we avoided the government shutdown. And I was wondering, could that be the case of why the pre-market is ripping so much? And as we've gone on today, it seems like it's kind of sold off. But I wanted to ask you, like, was the government shutdown news that happened kind of over the weekend like a big deal for the stock market, more than I thought it was going to be before the weekend started?
I think, we've talked about this, and especially the extent of computerized modeling that has come into the stock market. And it's nice. That's one of the things that like actually gives me comfort to speak pretty broadly, because not only have I been building these models for 12 years, but I've actually talked to a lot of places, pitch them, find out what they're doing. And it's really as simple as there's certain assumptions about the market based on, these events or a shutdown or whatever. And basically like, those assumptions get changed when news changes. And those are just kind of like, you might call them hard coded values, because an example of a non-hard coded value is like the SPY. They're like pulling that in, but like whether or not there's a shutdown or the date of the shutdown prediction, that's like more hard coded. That prediction that I'm talking about is more that could be more of a continuous space. But if there's a date, if there's a hard date for it, it's a hard coded value, right? So all that happens, like, and I think what we saw today, and when I kind of guided to in my newsletter, that there could be some short-term exuberance, but that might wear off quickly because it's only delaying until November. So even if that changes the models and that, you know, ups a little bit of like the excitement, the sentiment, everything like that, most of what these models are forecasting off are the bad scenario of like the government being shut down for 3 months, 6 months, etc. And there's like probabilities of those things happening, right? So those probabilities are still the same, and they're still being modeled in like the longer models, a year, you know, 6 months, whatever. It shifting back doesn't change those forecast values substantially. Um, so I think that is essentially why we saw what we saw, where it's just like, yeah, there's some relief, but at the end of the day, the model drivers, which are the actual shutdowns, there's still tons of unknowns in that, and it doesn't change the most important variable, where if it does shut down, how long will it shut down? So I think that's the main thing that we need to see, remains to be seen. um, and yeah, I think why I ultimately went with 5 bulls and 4 bears, because I actually thought we might even have a good full day today, but then the rest of the week would be bad. So I wanted to balance my portfolio a bit. But today has even been, kind of gotten to the end of gotten to the end of the exuberance rope pretty quickly.
Seems like a short leash these days. But to follow up to that, I know that like the number one thing the market likes is certainty. So I thought government shutdowns were kind of bullish because the market knows like nothing can change and no kind of regulations or different deals can happen or money spending and all these types of things because they have a certainty that just nothing's going to happen. So is that incorrect? So I guess it seemed like this case government shutdown would be bearish.
Yeah, I mean it's always bearish. But yeah, I would say that the main problem with the shutdown is, not only does it create a lot of uncertainty, but obviously you're putting less money into the economy. Like, especially when there's something like this existing consumer credit crisis. Like, think about how that stacks. Like, all of a sudden you have people, you have like essentially people that are already maybe short. They're like short on bills, or their companies or their retail business or whatever isn't getting enough sales into it, and then all of a sudden the supply of money going in is more limited. And I'm sure some of the jobs are yearly, but there's plenty of hourly workers for the government that obviously are not going to get paid if they're not actually working. So that's less money circulating. That's potential defaults happening on the hourly workers coming in. And so yeah, I think that is obviously a huge risk factor, and something that like could create that cascading effect that we're really talking about, where people are short on cash. They might sell their stock to make up those shortcomings, or the opposite, they normally put a certain percentage of their paycheck or whatever into stocks, and that's not going in. So yeah, there's definitely a lot of fear around, I would say, especially an extended shutdown. A short one is not going to move things too much either way, but leading into it, I expect we get some bear movement again. But yeah, very, very scary in terms of what it could mean for, especially in conjunction with consumer credit.
I know I have 2 cousins in the military, and they were very happy that we avoided it for now. But moving on to Tesla, which made a big announcement this morning on their deliveries, which I believe were slightly under what the market had anticipated. Seemed like Tesla stock isn't doing too crazily bad off of this news. Do you have any thoughts on them kind of missing guidance by a little bit?
Yeah, I mean, it's like one of those things that Tesla, we talk about it so much because it's so interesting. Tesla has this, big social sentiment. They have so many people excited about it, and as we've talked about, for good reasons. They touch the battery space. They touch, vehicles, charging stations, where all of a sudden, like, all of the American car companies are involved in their charging stations. Their personal robot is looking really cool, the Tesla bot. So there's so much long-term growth, and obviously Elon Musk, the name that is attached to it, however you feel about him, people are get excited about him. There's investors that are very loyal to him regardless, and that will just like invest in what he invests in. And obviously, we talked about this a lot. He's good at greasing the political wheels too. So you always have that like bullish undertone that, even disappointing news, there could be a good support level, because you can have all of these, people that just believe in the company long term saying, hey, buy the dip, there's a discount, all that stuff that is kind of a constant force in Tesla. And so I think what we see is when there's good news, we obviously see almost always a big move up. And there's not necessarily that same downward movement with Tesla, but, like a lot of social sentiment stocks, you can see if there starts to be a bigger collapse, say it goes down like 5%, that could turn into 10, 15 pretty fast, because that's the unique thing about retail investors versus institutions. Institutions mainly invest on numbers and forecasts and things that don't really change that much when the price is down 5%. Retail investors much more invest on, I would say, feelings than numbers. So a stock moving either up or down can create a lot of velocity around that kind of trading.
That's probably a lesson for people, is to try to not trade on your feelings. That's usually a bad idea, I would say, or even invest, not even trading. Um,
In the
Next
defense
topic.
of feelings, in the defense of trading on feelings, though, I will say, and this is obviously one of the things that Prospero tries to tackle by putting better metrics. The defense of feelings is essentially that when people have better numbers than you, better data, information, different sources, it's a lot easier to just go with your numbers because you're confident your information is better. So, like, I actually do empathize, because I will trade on feelings sometimes when I say, like, well, my numbers aren't added up, I can't make sense of this, I have to go with my feelings. So I will say that, but yes, to your point, it is best to remove feelings as much as possible and say, like, okay, I have my numerical systems, I would like to go with them whenever possible, but you got to go with your gut if the numbers that you have and you traditionally lean on aren't making sense.
Mhm. Okay, and that this is perfect, because we're about to talk about a person who I don't think has any feelings. That's Mark Zuckerberg. A lot of people say he's very robotic in his delivery of speech. He announced that Meta, I think they already had this partnership with Ray-Ban, but they're, I think, continuing it and delivering new glasses where it's going to be smart glasses. I think they're coming out soon this month. That, say you're going to like a building and you don't know what it is, the glasses have a camera on them where you can live ask them, like, what am I looking at, and it'll give you information about it. And do you think this is like a needle mover for Meta as a company, or just kind of like a side project for them?
Oh wow, it could be, and I honestly have no idea. Like, it's something that you really have to test to have any idea how well it would do. Because Google Glass, obviously, which was the first take on this, and that was a disaster. Like, it was a disaster from a product standpoint, and also just like marketing. They like put so much into this thing that kind of sucked and was before its time. And they had like way better, talk about walking into a building. Google Maps had that, and it has had it for a while. So Facebook and their locations, like, I honestly don't know. I think it really helps with Instagram and all of those people just like marking where they are and having those locations. That's super helpful to any location based system. Um, but yeah, like, here's the thing, and why I like Meta as the favorite stock of Prospero, and why we talk about it is, like, I think because Mark Zuckerberg is kind of like fundamentally unlikable, and has made some poor decisions, and is not like, maybe fundamentally unlikable is a little strong. He doesn't have a lot of charisma, and he doesn't have a lot to relate to. So yes, maybe that is fair, as in he's hard to like, because he doesn't give you much to like. He doesn't give you much to attach to. But like a lot of things, and I talk about my first like big lesson in value investing was my first boss invested in a garbage, like he said, his biggest win was in a garbage company. And I think that is a constant lesson I remind myself, in that, Mark Zuckerberg's personality relates to a garbage company a little bit, in terms of like, it's not going to make a lot of people excited to get on board just as a leader. And any stock, like the leader, the CEO, is very important to that. So I would actually say that, that is a big thing working against them. But the nice thing about the way that's set up, and obviously they have, in terms of forward EPS, in terms of the big 7 companies, them and Google are a much better value for 2024 EPS than all of the rest of the companies. Microsoft is like, they're both below 20. Microsoft is about at 30. And the rest are, below higher than that, like much higher. Nvidia being the highest, and why we kind of question its value sometimes. Not as a company, but the way it's valued. But yeah, the nice thing that Meta has going for it is, I see a lot of these things as upside, because a lot of people underrated them as AI. People underrate them as like other products outside of their core product that actually grew as well. For the non-Nvidia Tesla companies, they grew faster than the rest of the big 7 in their core product and in their revenue growth overall. So that's important to remember. Even without these things, Meta has good growth, and especially good international growth. But you throw in these products that, like, no one gives them any credit for innovation. They might deserve that, but nobody gives them any credit for innovation. They do have these products. They have some AI products rolling out in the next 6 months, and there's obviously like AI involved in that glass or in those glasses that are going to potentially help them get big. But if it is good, talk about a huge major event. I don't necessarily see that product not being good as big of a bear event as the bull event, if it is. And I think that's kind of the core premise of why Prospero and I, on an intellectual level, like Meta so much, is because I think the market really underrates their growth potential pretty categorically. So any additional upside, proven upside, like a new product, is going to cause the stock to go gangbusters. And we didn't even just see RBC, another major analyst, initiated coverage on a buy rating on Meta today, and that was one of the things that I think is driving it up. But that's a really good example of, even as the price increases, there's people starting to say exactly what I'm saying. You look at the company and you're just like, hey, they're a pretty stable growth and excellent profitability engine, above 80 in profitability and Prospero. And any of these new products, if they hit, and there's many of them coming, are going to send the stock soaring. So even these glasses could do poorly, but some of they're basically building what South Park joked about them building, and who knows? I would love for them to have gotten the idea from South Park. But there's basically an episode on AI where all these kids are like chatting with each other using ChatGPT, and basically Meta is building a product to make that easier. So in Messenger, you could basically like have your messages filled out for you. And I do think a lot of people will use that. I don't know how they're going to price it. That gets tricky. Maybe they'll just sell ads like in your messenger. That's more of their model. Like, hey, watch this 30-second ad if you want to keep using the autocomplete. But yeah, there's actually too many of those products to name. They're not even necessarily out there, but they're finally doing some smart product development. And I would say, like, as a good rule, if you're analyzing any company, and what I said about them and why I was like, oh God, Zuckerberg's being an idiot, is large companies, you don't want to see them do what you might call, greenfield R&D, where they're looking at something like the metaverse and plowing a bunch of money into an unproven R&D project. Like, Meta acquired Instagram, they acquired WhatsApp. They actually have a good model of letting all of that R&D be done, letting the product be proven out, and then acquiring. That's actually worked for them. So there are product companies that are better at R&D that any R&D wouldn't scare me. For example, the way Amazon moves into products we talk about all the time. Like, I would implicitly trust an announcement of a product they're doing, like 10, 20 times more than Meta. So when you do that, you're showing that like that seemed like a vanity project for Zuckerberg, or I don't know. He thought he was smarter than he was. I don't really know. Maybe just really liked the metaverse, didn't want to miss out, wanted the next big idea. But even the strategy for a good R&D company of kind of getting in on a very new product line before it is even really a product, because who figured out how to monetize the metaverse already? Nobody. So getting involved in an unproven product as a juggernaut that is not experienced in R&D or successful R&D other than like your original product that, by the way, he stole from the Winklevi. So he was really never good in R&D. So why he would decide all of a sudden to lead a massive unproven R&D effort is beyond me. But to put it more broadly, like anytime you see a company like that, their DNA isn't like kind of like greenfield R&D, like brand new, like then that might not be scary. You might want to say, hey, that could be a big growth opportunity. But anyone that hasn't pretty much proven time and time again that they can do that, I think is a really bad use of capital to get into that new business. Whereas, you know, you let people tinker around. You don't have to wait for them to become as big as Instagram or WhatsApp before you acquire them. You could have a proven monetization model in the metaverse, and then just go and buy, you know, what you think is the best product in that area. That is the smart way. That is the way that Meta has actually proven itself to grow. So why they took that detour, I have no idea, but it is a good idea, and that soured me on them. Obviously, like a lot of people, why we and many others were able to get back in on Meta early as a good value and kind of write it up. But yeah, that is something generally to watch out for. You do not necessarily want people doing major R&D projects that aren't proven innovators.
And maybe what you're saying is exactly why Mark Zuckerberg felt the need to do this, because he hasn't gotten credit for starting Facebook, and I guess he shouldn't. And he hasn't built the companies, like you said, he's acquired. So maybe he's the guy who's like taking on jujitsu and taking on challenges. So maybe he just wants to take on a challenge. But what I want to ask you about this VR space is that, Apple's releasing a headset. Facebook already has Oculus headset. It seems to me like glasses have a much higher potential, since you can go out in public with them, and the headset seems kind of bulky and just not appealing visually. So is that how you feel about it too, where glasses seem to have a more broad appeal?
Yeah, the only cost is like Google Glass is that you look like an idiot. Um, no, I mean they did look really stupid. Even Sergey, who generally like looks pretty cool, I would say, like looked like an absolute tool wearing those Sergey Brin, one of the founders of Google. But yeah,
Did
I think he generally looks cool, but not in those Google glasses. Why, you want to
you
jump
know
in?
you know what I had? I had a pair of Google cardboards. Did you ever have that?
No.
They were just this like box cardboard that had a certain like two glass lenses where you could put your phone inside of it and it would kind of make it like 3D. It was pretty cool. It was like 10 years ago. It was
Oh,
way, way, way in the past.
that is cool.
Um, yeah, but that
But
was a cool, interesting space.
no, I mean honestly, like I like Ray Bans. I had to I have some. I actually dropped some recently, but I bought them at a thrift store because I stopped buying new Ray Bans because, like a lot of people, I'm afflicted with a sunglasses leaving problem. That being said, Ray Bans are pretty cool designs, lots of different designs. Like I would trust them. Like if you told me like Meta was designing a product on their own, I'd be like, good luck. But working with Ray-Ban, I don't think they're going to put out a garbage thing. And like, yes, I do think that if they look cool, even if the function isn't as good, you might have more people wearing them, and they might do better than Google Glass, which did not look. I don't know what they were thinking on that one. But Google's never been the best at design generally. Actually, all their Android phones, they really like pretty much they had a good operating system, and they pretty much depended on Samsung to rip off Apple to make their operating system go. But I would say that it could potentially, yeah, like if it's easy to get around, like if it's easy to wear around, it looks cool. There's sunglasses anyway. That I think is the potentially really good part. You have people that just would want to be wearing sunglasses anyway, and they like if they add any value whatsoever to you being able to find things, then that's a good product. You're better than, your naked eye. Like, depending on, the price, it might be a limiting factor for some people, but if they make them cost close enough to like regular Ray-Bans, which they might be able to do, especially with like Meta footing some of the bill to like get the product adoption, they might actually be a pretty reasonable price relative to other Ray-Bans. So yeah, I think that could just be like absolutely huge. And that's the kind of thing that like a couple influencers start posting on some things, and it really like, and the stock just like starts to go up because people are seeing like people using them, even if it's not a good product. It's a good event to watch for. And I certainly will be looking at that myself as like someone who's holding Meta and the newsletter portfolio and our model portfolio. I will definitely look for the difference between product quality and product excitement. Just because I think often like some product excitement can make people not look at the quality, and that's actually a potentially good way to exit a stock with a nice profit. Then after it goes down, after the product excitement, exit your buy. As the excitement goes down, stock goes down, then you just re-enter.
Yeah, next thing you know, me and George are going to be wearing smart glasses by Ray-Ban and Meta in our next live stream for
Yeah.
advertising for Facebook.
I
But
mean, I've made enough on Meta options this year that maybe I should do that for them, pay it forward.
no doubt, no doubt. Spinning to our next topic, Coinbase announced this morning that they got a regulatory approval from Singapore to start, operating in that country. The stock was up. I think as the day went on, it kind of maybe came back to even a bit. And I know you're not the biggest fan of crypto, but I thought this was kind of cool news. So, do you like Coinbase as a stock?
I was just looking at it on Prospero, and it's actually got upside breakout higher than downside breakout. It's all like it's doing all right. It definitely looks like it's going to survive the crypto winter. So that's like in terms of a long term hold as like a survivor, I like it. It's not necessarily something I would buy now, but yeah, I think Coinbase is operated solidly enough to survive when like all of the other things kind of died. And I would say like why I don't really like crypto. And I was just getting into a discussion on it of someone who was like buying like 40x and 80x levered like perpetual future crypto contracts and like putting them in a group as if they were a good investment, where it's just like, that is one of my problems. It's like, honestly, why are you making it so easy to get 40x, 80x levered things? It's like you are trying to get people to gamble their fortunes when you make like coins like that. And I believe Coinbase makes those. I don't know for sure. I think I saw on the screenshot something about at least they were traded there. And so yeah, like that's just like irresponsible collateral, like to make it that easy to own. Like, it's nice that they don't have expirations, I will give that, and the value doesn't go to zero, but making that much leverage like accessible on these basically like penny cryptos, irresponsible, should be illegal. And the thing that I like talk about on crypto all the time is that like I actually asked a panel. I was at a Google Cloud event for crypto. I think it was like it was for decentralized finance or something like that. And I actually asked a question to like pretty much someone who was the most prominent hedge fund there on a panel, and I said, well, like, how do you look at the options markets? How do you look at leverage, which is like these levered funds, and options are leverage. So the person who I was actually talking to about this didn't get that, as they were recommending leverage, that options are leverage. It's all just a levered, riskier transaction than the core, owning the core collateral like the stock. So basically, even the most well-known crypto hedge fund doesn't aggregate all of the options bets on even Bitcoin, because they don't have access to them. They have access to certain exchanges, and there's not regulation. Like, the nice thing for all people who complain about equities, there is a single options clearinghouse where everybody buys and distributes data from. And that is pretty organized. And that's why like there's a standard open interest on all of the options. It gets published once a night. It's the same number for everybody. It's all of those options contracts. So for everything that people like complain about, like, equities and like, oh, crypto is the next foundation, it's like equalizing things. No, sorry. Nothing is equalizing anything if there's non-transparent, non-centralized options leverage markets. Like that is, incredibly dangerous, incredibly risky, very like gambling centric. I actually didn't even know. I started like looking at crypto because I like to research everything by like I was moving some around, I was buying some, part of my equity research process because of companies like Coinbase. But yeah, it is actually, by the time I found that out, I was like, no, like there's no way I'm going to participate in this market until there's at least a clearinghouse for all of these options contracts. Because for people that don't know, and you might have been screwed by this in crypto, like you could be looking at the whales and the whale wallets and all that stuff that they show you, and people could be like moving money in, they could be buying the coin, et cetera, but they could be betting 10x on put options and or selling you calls on the other end when they're about to pull the plug on the price and just like stealing your money for buying those call options or sending your levered transactions that they're betting the other side of going down incredibly quickly. And so for all the complaints, there's lots that needs to be fixed about the equity markets. We are obviously trying to go to great lengths to make that easier, but at least there is a single options clearinghouse, and there is a source of information that counts the contracts properly. And yeah, I don't even know why people hear that and are still would get that piece of information and still want to buy an 80x crypto coin. That seems like insanity to me. Especially the same kinds of people that invest in crypto are the same kind of people that I often hear talk about the market being corrupt, manipulated, etc. It's like, okay, well, you're just signing up to like lever yourself up on a market that doesn't even attempt to fully get rid of the manipulation, the lack of transparency, etc.
Yeah. So it seems like Coinbase is not the stock we're gonna bet our life on. But I wanted to ask you, because we kind of poo-poo Robinhood and
I
some
will
like,
jump in that I would say like, yeah, like if you like crypto, Coinbase is not a bad way to get exposure. I would recommend Block, BLOK. That ETF is the best way, I would say, to get broad exposure to especially the blockchain, which is I think the better piece of technology. And in Block, there's companies like PayPal and Square that have blockchain exposure. So that would be my recommendation. And there's miners, there's everything in the ecosystem in that Block, and that's diversified. If you want crypto exposure, and I would say for anyone, 5% crypto exposure in your portfolio is reasonable. I just throw it into Block.
so what I wanted to ask you though is because I just mentioned that like Robinhood is kind of a no-go for you and a lot of people, especially after the past couple of years, what's happened with them, is what platforms should people be using and are your favorites for investing? Because I feel like we haven't talked about the actual good ones. If you have a few in mind or one sole one, or until Prospero starts letting you trade.
Yeah, well, it's kind of funny because like payment for order flow has like become a big thing, and like most brokers admit to payment for order flow. Like and payment for order flow is way older than Robinhood. Now, a broker like Public that makes a big song and dance about payment for order flow, they actually have, I don't know if they still do, but at a time had like automated securities lending. So they're basically making money off lending out your shares. And most people have to like, play with that. But, that's actually, if you go and look at their revenue, that's where a lot of it comes from. So no trades are really free. Fidelity is the one that I will admit I use Schwab just because like that is actually for me the best mix of usability and not being horrible. I would say the horrible stay away from them ones are Robinhood and Webull. I would say kind of by far it's those. And in terms of like Fidelity is just like in terms of the management of Fidelity, the way they're built, the way they've been constructed. That Vanguard is really good too. You can do some trading on Vanguard, I believe. Those two are probably best, although the interface on that is just not very good. So if you want to go pure, just like benevolence, and purpose, Vanguard or Fidelity, I just trust their management. The way they're built in their DNA was basically to wire this more fairly. And Vanguard literally puts their money where their mouth is, where their fees are just like much lower than everybody else. But as an app, Fidelity has more features than Vanguard. And then I would say in terms of like usability and management, I would say that that Schwab is the next best after that. And just because like I'm trading and I need an easy app to do it, that's what I use. But I've been meaning to switch to Fidelity and learn it. But that's kind of the list. And definitely like nobody should trade. If you care at all about market manipulation and retail getting a fair shake, don't trade in Robinhood or Webull. It's just a bad. I admit I use Webull for research because I actually really like their research, but I do not trade there. I would never trade there. If you do care about market fairness, get your money out of those things ASAP.
Now that's a quote. So last week, if anybody caught it, any of our viewers comment if you saw George's discussion on AI. It was a little special. I think it was last Thursday. If you didn't catch it, you should go watch it because it was very interesting. But if you just want to talk about it a bit, George, and say like kind of how it went for you, and if it was like an awesome conversation. I forget the person's name. I think Villarubia or
Yeah,
Villarubia.
James.
Uh-huh.
And he's a
But he
NASA
works at
undergraduate.
NASA.
Watch it. Yeah, he's a presidential fellow at NASA. And actually we didn't get to all of my design topics. There's a fun one at the end where we just like both talk about AI moving into a business. But it's interesting. We talked about everything from AI theory, what companies have the best AI and tech in his view. We actually had some differing views on this. And then we went into like the mechanisms of the market, his more experience in general applied AI, how my experiences and what my knowledge of hedge funds work kind of interacted with that. And I actually learned from him. One thing that I didn't really think about was like I used to think of systems as either like multi-agent frameworks, which are just like small computer organisms that kind of live and die and get their resources by how well they perform. And then these large models, like large language models that are a big brain. But actually what he was telling me is like some of the most successful ones are hybrid agent systems, where the big brains are the agents that can vote or offer different perspectives. And I had kind of thought of that as a binary, and that was like I would say that part was educational for me. But really it's a great I would say we chatted about it afterwards, and for those that are of the technical mind, he did like a deeper dive on the technical aspects to it, and I tried to like pull it out and educate on the way, because he's actually used to speaking with people that are technical, much more educated on AI than the average retail investor. So it was really interesting because like he kind of took bigger bites and deeper dives than I normally would. And I think it was if you're curious on how you get maybe from like the depths to the shallower levels that we talk about it on here, it's a must watch.
Mm-hmm. I definitely noticed, I was watching it, the passion from you and him on the topic. So it was really interesting discussion. I would recommend it for people. And I wanted to segue into the article that you were sharing about how AI, algorithms are actually underperforming the market in their trading. But one of my favorite things that I see every week is when you send out your weekly newsletter and Prospero AI is beating the S&P 500 by this much. So it seems like Prospero has figured it out. So what has Prospero figured out that it seems like these other algorithms haven't?
Oh man, we dipped under 100% in excess of the S&P like maybe like 3 months ago, and then recaptured it the next week. But I don't know. We're at 83%. I don't know if we're going to recapture 100% in excess of the S&P by the end of the year. But no, obviously our performance is great. And I would say that the difference is like those like general nonlinear equations, and we talk about this all the time, they're competing against in trading against the institutions. And I advise retail all the time, don't try to beat institutions. Don't try to beat institutional grade AIs. They have more engineers, more experience, more money, better data. Like anyone that's like these like smaller operations that claim they're competing, they're either don't know the market well enough themselves to know they can't like keep that performance up, or they're selling snake oil knowingly. But like, so you have these like nonlinear competitions, and I would say like especially like what the Chat GPT ones are doing are leaning on social sentiment, which is even worse because like social sentiment can perform well in different in different environments and have streaks, but essentially like it's what we're talking about. Like the problem with social sentiment is like it can go up, but then when it changes, it snowballs super quickly. Or you actually have, and I think what we saw is institutions form strategies around pulling in social sentiment investors only to suddenly rug pull or whatever. So I think that a lot of like, especially internet-based information, that's going to be looking at sentiment. And what we do, obviously, in social sentiment or news sentiment or things like that, but we're really looking at the way that institutions price options. We're aggregating that information. We're looking at things like, acceleration of the price changes, differences among different options expirations, how those portfolios perform, and the way that the easiest way to explain even what a lot of retail-based products do that we disagree with is like something like an option sweep order that gets printed. There's prints on those things. That's looking at a single contract being bought, hundreds of thousands of that, millions of dollars worth of that single options contract gets pushed out as an unusual options alert, right? The hedge funds know those get sent out. They know those parameters. And like my general philosophy is any information that hedge funds know will go out is to benefit them, not you. So you might make money here and there, but you are actually being a tool in their messaging system that actually ultimately helps them fund better, make more money off of this like unusual options alert system. So what we do is very different. We look at, instead of one contract, one expiration, we will look across different contracts above and below where the stock is trading for a single expiration and a bunch of other ones. And we look for consistency in many institutions pricing options across expirations, across different strike prices, where they're valuing calls above where the stock is trading versus puts below. So it's a very logical reason because like we're literally saying there's more institutions betting more money on the stock going up than down. And when you boil it down to that, that is so much of a better signal than crawling social sentiment or news sentiment, or even like an option sweep order that's just looking at one contract, one expiration, because we're looking at a lot of contracts, a lot of expirations, and all institutions, as opposed to one or a few that you get an unusual options alert on.
And you were speaking in there, and obviously we're talking about like institutions and stuff. And I was thinking, oh, this would probably make a really good short video. Oh wait, I don't think YouTube would want us to post about this too much. From what we've seen, it seems like there's some kind of connection with the institutional side.
Maybe we'll do one more as a test. It is, yeah. Like, YouTube does not like.
You just said like I know the thing you just said. People would like love to hear, but it just seems like they kill it immediately.
Yeah, they don't like those kind of words. Maybe we should find out. Maybe we should experiment with you like dubbing over the text where you put a different word in the analysis than I say. And like blanking out the sound when I say it or something like that.
That's a funny idea. Maybe you should treat institution like a curse word and just put the asterisk or whatever.
Bleep it out.
Yeah.
That would be hilarious.
We'll see.
You should try that. I actually think you should try that. But yeah, I would definitely say that the other thing that they banned that I know that they're clearly like was our streaming video where we said there was too many streaming services. So they definitely didn't like that. But YouTube streaming is a great service. I watch Sunday Ticket on it now. I'm getting my football. I'm giving them money. I'm a very happy customer of YouTube TV. Let's get that straight. YouTube TV, YouTube, love them.
Hmm. We just covered our bases there. Too much institutional chat. Hopefully they're not watching. Um, Here's a fun topic I thought of, which would be kind of an interesting little kind of game, like how you played with last week in the AI space. I wanted you to rank your Mount Rushmore, which is top four for people, of CEOs, and maybe if you want to give like a current list and then an all-time list, if you want to separate it like that. But because I've heard before how important the CEO is might be more important than the actual business or product or whatever. So should be interesting.
So we'll do current first. And Buffett, number one. So not only does Buffett like the innovation that some people don't know about Buffett that is just absolutely incredible is he invented investing float for like Geico was his insurance company. And basically a lot of, when insurance obviously collects your premiums before they pay out, that's called float. So you have all this cash that you're sitting on. And he put that float in his good investments. So that's one of the reasons he was able to turn Berkshire Hathaway into the empire that it was. And that is like an amazing innovation. Obviously, he runs that company really well. He spots economic changes really well. He's just a fantastic leader. And like not only that, the funny thing that actually like was an epiphany to me that some people don't know about Buffett. It was maybe in my I was talking about him, and obviously I started as a value investor at actually the Graham and Dodd Value Investing School at Columbia, which is the mecca of value investing. And it wasn't until I was explaining maybe I don't know 100th time, it was a lot of times about value investing and Buffett and why I liked him, that it occurred to me that he was also he's running the companies he invests in. Like if Buffett's like a large stakeholder in your company and he has a tip on how to run it, or he says, hey, I'd put more money in your company if you did it this way, of course you're going to listen to him. And of course, you have made your decision. If Buffett's a major shareholder, you're going to get his input. So running might be a little strong, but he is helping his investments do well, as he very well should, as is any hedge fund. But the bottom line is, if we're talking about a very sharky hedge fund that turns over the positions a lot, if you're the CEO of a company, you're going to be nice to them and listen, but you're not necessarily going to take their advice, because Buffett is a long-term investor and some of these shorter term might not be giving you the best long-term advice for your company. And you might even have to wonder if it's like that. So Buffett, then for current, we're doing first Jamie Dimon, who I'm actually speaking at the same conference as Jamie Dimon on December 3rd. I'm very excited about that. Me and Ray Dalio and Jamie Dimon are all going to be, I'm actually one of 17 speakers at that conference. So it's pretty exciting. They must watch these live streams. No, I'm just kidding.
Maybe I'll go and live stream on our channel.
Yeah, Jamie Dimon. So basically, JP Morgan was, pretty much just one of the other banks. After it was pretty much like Goldman, Morgan Stanley was after that. For a while, Lehman was, in that category, maybe, but then there was a bunch of the other ones that didn't really matter. And JP Morgan rose from that under Jamie Dimon's leadership to pretty much the unquestioned number 2 to Goldman, and is nipping at their heels a little bit because they have such a great technology program. They make amazing deals. Jamie Dimon, I think he managed to in the Silicon Valley Bank, I think he managed to weasel $5 billion out of the government for that. Talk about a good, well-run company getting paid $5 billion to do an acquisition that was, pretty beneficial to them anyway. They were just holding the government under the file. There were some assets that are going to take work for JP Morgan to unwind, but the most valuable part of Silicon Valley Bank was their customer base that a lot of people wanted. JP Morgan certainly wanted that customer base. So we have those two. And then I would say, Elon Musk is going to be number 3. But for reasons that we've obviously talked about, like he does, and I think the big thing about Elon Musk is he's wired to be like he works more than anyone else, whether or not they're his ideas or whatever. He brings a lot of ideas to the forefront. He is just, and he knows how to grease the wheels in the government. He knows how to like acquire talent, get people excited. That's really the job of the CEO. I mean, it's pretty incredible right now that Tesla and SpaceX are doing as well as they are. And like the story with him and SpaceX was basically that he had no like aerospace, no space experience. And like someone I think like famously asked him that when he was thinking about doing it. And he was his attitude was just like, I'll learn. So I think that's a pretty good attitude. Then 4 on the list for current is Jensen Huang. He has done an amazing job with NVIDIA. I mean, especially if you're considering how quickly it's happened and how much they're still growing. Like he's become the elite brand in chips, in AI chips especially. So that's your Mount Rushmore. I don't think I'm saying anything that controversial there. And I wouldn't necessarily rank them in that order. I would put Buffett above and beyond the other 3, which transitions to the all-time list. Buffett is there as well. Not head and shoulders above everybody else. But I have a very non-traditional favorite, like one of my favorite CEOs. I would say as a CEO, and I'll tell some stories about my next 2. As a CEO, I like to model myself after this person, and one of them, his name is Bob Noyce. Most people haven't heard of him, but it's one of my favorite stories where him and a group of scientists invented the integrated circuit, and under this guy that was like end up winning the Nobel Prize for it, blah, 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 all this stuff. He became a real jerk after that and didn't really give his team credit or whatever. And they basically, all of these scientists that helped him invent the integrated circuit had a coup. And they all got together and were like, well, we don't want to work for this guy anymore. We're all really smart. We want to go do something else, not work for this guy. And they basically, none of them wanted to be the CEO though. And they went around the table and they all said, Bob, we think it should be you. And Bob basically says, well, no, I mean, like I'll do it, but I have a condition. I'm not going to be like a normal CEO. I want to do it my way. I'm not going to be like flashy, overpromising. Like we're just going to do the work, and I'm going to help us do the work. And so they all said yes. And it didn't take a group of the most talented scientists very long to get an investor at Bell Labs. And they started a company called Fairchild Semiconductor. And they started blowing up. They're like, Texas Instruments was their main competitor. They're starting to like eat Texas Instruments for lunch. And Bell Labs and Bob basically is like, well, my team needs more money. You're taking too much of the profits from Fairchild. And the guy who was his boss is basically like, well, you can fuck off. This is the profits we take. This is our contract. You work for Bell Labs. And so for the second time in Bob Noyce's career, he like went and he gathered his people. This time he conducted the revolution. And he went around and was like, I don't want to deal with this guy anymore. We're doing too much work, not getting enough credit. And so he starts his little revolution. He starts a new company and he says, well, I don't want this. I don't want to deal with the same stuff that I dealt with at Fairchild and Bell Labs or whatever. So in this new company, it's going to be really egalitarian. Everybody's going to have a cubicle, flat organization structure. We're just going to be about making great chips. Do you want to guess what that company is called, Steven? Anyone in the audience can guess too.
Guess this company. It's a semiconductor company. I have no idea. Don't tell me it's like AMD or one of the giant ones.
It's called Intel.
Intel.
And everybody's heard of Intel. Not that many people have heard of Bob Noyce. And I think that's one of the things that makes him really cool. Like, he just got the work done. He created good structures. He took care of his people. So that is one of the like entrepreneurs I like to model myself after. And the second one is Steve Jobs, who is also on my all-time Mount Rushmore, who is just like, I think the job of a CEO is to inspire and inspire creativity. That's the most important thing. And in inspiring creativity, I think you have to be very supportive of your people. And I think that, yeah, I think where I don't want to be Steve Jobs and where I want to lean more towards Noyce, there's a funny story about after he was ousted from Apple and he was basically interviewing for Commerce Secretary. And all of these people that they talked to, all of them were just like, oh, Steve's great. He's an inspiration, all this stuff, blah, blah, blah. And then a lot of them ended with like, as long as he's getting his way. And the people that interviewed him were kind of thinking of like, oh, like, well, what happens if he doesn't get his way? And nobody answered that question. They all just like pleaded the fifth, basically. And he didn't get the job. And it turns out, and it's come out a little more since, that Steve Jobs was very scary if he didn't get his way. And as long as the creation was happening and everything like that, everything was going well. And yeah, I think that is that's a really funny kind of story about him. And where I like to be like, okay, you got to be equal parts Bob Noyce and Steve Jobs. You got to be an inspiration, but you also have to be like relatable. You have to be able to be like a teammate as well as a leader. I think is really, really important. And he, Jobs was the inspiration. And obviously you can create a great company. But I don't really like the idea of a life where I've created a great company, but people are scared of me. that doesn't sound like a good, or all of the people that worked around me are a little scared. That doesn't sound like a good life. Then the last, I think it's Sam Walton. That was the guy that started it. If it's not, I apologize. He's dead now, so I'm not. But anyway, the guy who started Walmart, I believe it's Sam Walton. And the story I'll tell about him, and I read this book called Built to Last. That is a great book, by the way. If you want to learn about companies and investing and maybe how to evaluate them, I think it's great because it's actually like an academic study, longitudinal study of companies, and basically the main thing is how they survive a succession plan. So the idea is like, can you continue to innovate? And the whole idea, and I talk about this with Amazon, that's one of the reasons I'm so flattering of Amazon, because what I learned from Built to Last was that the most important part of a company succeeding is organized processes. That when you have a captivating, charismatic, etc. leader, that's great. But if you're going to survive after that, you need processes. But the amazing processes of Walmart, and obviously you see some of them failing a little bit as they've lost to Amazon, I'd say. And they shouldn't, like, there's no way Walmart shouldn't have like crushed Amazon like a bug at various times. Just not good leadership. But that tells you the difference between processes and processes to innovate, which is why I like Amazon, because they are good at moving into new markets. But like why I like really like Sam Walton and this story is, not only did he figure out like all of these things in businesses, like I think very early relative to everyone else in terms of like how to scale, he had his greeters, everything from like both figuring out how to minimize prices, but also like take care of customer service, I think is really brilliant management. And a lot of their management, middle management, came up from within, and it's just like a really, really good way to run a company. Even though, like, we can talk about Walmart and what they do another day. But there's a story that makes me like Sam Walton more, and it's from Built to Last. And basically, it's the guy who wrote Built to Last they're hanging out outside of Walmart with Sam Walton, and Sam's like talking to him about like what he looks for, how he's managing it, blah blah blah. Sam Walton has terminal cancer. He might have like a month or two to live, and basically the guy's like, "What are you doing? Like, you're a billionaire. Just go. Why do you want to be on a beach like with your family? Blah blah blah." And Sam goes, "I don't think I'd quite take it this far, but I do respect the attitude of what I'm about to say, which is that he said, this is what I want to do. I love to do this. I love checking out stores. I love building this company. Like, I love to do this." And I think that's a really good message for anyone and anyone that you're going to like trust as a CEO or evaluate to make it like broader if you're looking at a company. Like, if you really think, like, I look at some CEOs and I'm just like, this is a job. This is a job, and like you're not even very good at like pretending to be authentic, which most CEOs are coached to be now. But yeah, people that I really think, and the people that come to, like, all of the people that I just named come to mind thinking of that, and like some of them take it too far. Definitely, I think probably all of them took it too far. But yeah, I was just telling a story about like Warren Buffett and basically how like him and his wife, married many years, ended up getting divorced because I think she was under the impression that at some point they were going to like enjoy their wealth, and he still wanted to like eat his McDonald's breakfast and study companies. And they ended up getting, I don't know if they're divorced, but they're separated. And I think that there's a balance. And I think that luckily society doesn't demand that of people anymore, to be like that committed. But at the same time, I don't trust anyone as a CEO. I don't really want to invest in them. I will if there's good value there. But I've got to look at the person and say, this person loves to do this. Those are the ones that I really have the most faith in.
Mm-hmm. You know what they say, love what you do and you never work a day in your life. And limiting the list to 4 people, it's tough. Like, Jeff Bezos didn't make it. Satya Nadella didn't make it. There's a lot of great CEOs, but yeah, I think that's a great 2 list for people to check out. And that book is a good tip for people if they want to, read up on, what was it called again?
Built to Last.
Built to Last. Yeah, I'm going to check that out.
Yeah, I think that like Bezos probably would have bumped Wong if he was still
current.
active.
Yeah.
But yeah, I would say like a lot of I would say just like Bezos, I don't like what Amazon has become as much as like, some of the values of the other companies. And I guess like, Walmart isn't like necessarily in that, but like Bezos can't, like, Bezos middle class, worked at D.E. Shaw. Like, Sam Walton's story is like, he's just like he was just a regular guy that like figured out like all of these kind of pretty big innovations in retail. And I think that like, Bezos kind of took those innovations to the next step, right? But all of it is just like supplier negotiations, customer service, like Walton invented a lot of those concepts. And so I would say that's why, Bezos didn't quite make it there. But yeah, I think that it's close. It was hard, but I think that Walton, that Walton story, and like the way that it was like, he kind of treated it like a family business, and a lot of his family was in there, but I don't get those vibes from Jeff.
No, certainly not. I know we're over by a few minutes. I don't know if you want to talk about a little bit macro before we end, or take some questions, or if you want to keep going a little bit.
Yeah, I mean, we can take questions. I don't have a hard stop. We generally stop when the conversation runs out, and I think we can do macro. I mean, it's not nothing really all that new. Just I do think there's like the yields keep going up on bonds. And I think that like, yeah, the market is just behaving in a way that it is not really it's not really selling itself as confident that rates are going to go down. And obviously, that behavior is based on less confidence that we're going to get on top of inflation in a timely manner. And I think that like the market generally, like I think the thing to say that's like very concerning for me, and obviously like when we talked about a shutdown, that just like exacerbates these problems. But it's like we have consumer credit, like making people's bills higher, like because there's more interest payments, or they might even have things that they they might need to like make more balloon payments depending on the type of loan, etc. Then you have prices that are staying high and were high, and you're not getting the wage increases to match either of those things. So interest payments are rising, maybe your college loan is kicking in again, and also you like availability of credit isn't as big. And that's the thing, like sometimes a lot of people get out of some of their credit problems by getting other credit. And so like if availability of credit is not necessarily there as much, that's a problem. That's a problem too. So you have all of these things conflating to potentially a really bad consumer, like some real consumer spending limitations, which obviously have broad effects in a lot of different directions. So I think that's the concern, and that's the concern that we're seeing with the market, and like why I kind of constantly say these days that like I think we will see little bull runs. I don't think it's just going to be straight tragic bear run, like obviously, especially because we say like if it gets too bad, Powell will say things to support it. But yeah, I think until we get farther along in the inflation reduction story, there's kind of a cap on how bullish the market is, and the bears are going to win in any bull run.
It's been really interesting to me as someone, who's still early in their investing career to watch how like long it takes for things to play out in the stock market. It's like you see these problems and these things happen and you're like, "Oh, you expect it to like resolve," and it's like, "No, it takes like 18 months, 24 months, like some crazy amount of time." It's like the time frames in investing are just so long.
Yeah, I will say a few things on that though. The first being that uh bears are always around. Like that's the funny thing. If you're looking for them, there's always gonna like, no matter how good the economy is, someone's gonna be like, this is the end. I have all these problems, like blah blah blah. You're gonna constantly be barraged on that. So like that is the one thing in terms of these bear narratives that everybody should always be cognizant of. The other side to that, however, is that like, yes, these like real situations are very interesting because like, yes, there's a credit crunch, but it might not end up impacting consumer spending that much. There's going to be a long story, like, because some of that is like, how much job loss will we get from these interest rates? Like, it's starting to impact the jobs market a little bit. Like, there's so many different levers that are being pushed and pulled that like, yeah, you're correct. Like, we won't know that we're out of the woods, especially because of how much interest rate increases can lag. Like sometimes you could still be feeling the impact of interest rates even after a few cuts. So, and obviously cuts get more aggressive when that happens. So there are other levers to pull there. But yeah, you're absolutely correct. There's always going to be these looming bear crises, and people just have to figure out like how seriously to take them. Personally, for me, and the differentiator I'm making here is that like typically you're going to have very friendly interest rate environments and no real reason to increase rates or leave them at elevated levels. And that kind of removes the cap on the market that we're talking about, because the second that it's not really an issue for interest rates to rise or stay flat at elevated rates, then all of a sudden the market going up is great, and it'll probably get more and more velocity going up. The problem is there's a circuit breaker on the market right now, and Powell's being pretty open about that. if there's too much exuberance, he's gonna keep rates higher for longer. He might even do more rate increases. So yeah, that's the major risk, and essentially what is stopping me from ever being too bullish in this market.
Well, I think you've walked the line pretty good so far in 2023. If anybody has any questions, but whatever your last finishing thoughts, George?
Yeah, no, I mean, you're saying I've walked the line. It's tiring work doing it, and I don't like, we try to make it easier, but it is really all of these twists and turns, like going from bullish to bearish like 2 weeks in a row, and we like nailed it both ways, so it's great. But it's just like, honestly, I am, we are close to raising our seed round. As part of that, I'm kind of shedding more of my like you might call them back office administrative tasks, and I have more time to actually like focus on the model portfolio and things like that. And it's just like, it's so much work. Like, it is a job. Like I always say, for people that trade, it's like it should be its own job. But it is like, yeah, I don't envy, and why I'm happy we have some really cool tools we will continue to make. Like, we actually have someone close to coming on and helping lead our market profit project, which is going to help show the market the prediction for the market today, tomorrow, a week from now. So that part is great. And we're going to be offering more tools on that level. But yeah, it's not an easy activity to do that. Okay.
That brought up an interesting thought for me, for like, would you give up 10% of performance for like 20 hours less work, blah, blah, blah. But we'll get into that another time, because yeah, we do have a question. They're just asking, are you bullish or bearish on the market in a 3 to 5 year time frame, regardless of what happens in the economy?
Yes. Yes is a simple answer, always, because like the US runs on the stock market. Like, that is our baby, that is the economy. That's how we like court international dollars to come into the economy. Like, both political parties are very well financed by Wall Street, on both sides. Some of the same funds finance both Democrats and Republicans, or people that run those funds. So yes, the one thing that you can count on in terms of legislation in the United States is legislation that protects the returns of the stock market. And I think, I forget what it is. I could follow up, but I think there's been like not many or zero instances of uh of 2 bear years in a row. I forget, but either way, it's very few in the whole history. But yeah, it's like not. I think it would be insanity, no matter what's going on, to bet against the U.S. stock market until the government actually starts to like falter, which might not be like on a 10-year horizon. I could see the U.S. government faltering like to an extent where they couldn't prop up the stock market, but I don't see that happening on a 3 to 5 year time frame. What time frame? Long-term bets. Long-term bets are a year. That's what we target. That's like a lot of our options formulas are targeting expirations of a year or longer. But we've designed the long-term metrics to say, like, okay, if you buy and hold for a year, you'll be happy if you're above 80 and upside breakout, say. And I would say you'd be very happy. I've seen very few instances of looking at like upside breakout above 80 and profitability plus growth above 120 not working out. That is a very high hit rate if you hold for a year. Does that answer your question?
Seems like a pretty good explanation for Mauricio.
I like that. I like that Prospero got a little accent for Mauricio's typing.
I saw that. See?
Oh.
No. Yep.
Yeah. All right. Well, we went way over, so I think we're gonna call it quits. But yeah, thanks for coming, everyone. This was a great stream.
Yes, great stream. I think if you enjoy the stream, share it with some people you think who would find it interesting, because trying to get some people in here, and we think we provide value, so some people may enjoy it. And if you see us in our short videos, comment if you saw it first live in the stream. We'd love to see you there. See everybody next Monday, 11 a.m. Thank you, George. See you then.
All right. Thanks.
See everybody
Bye.
there. Bye.